All right. Hi, everyone. It's 6:30, so we'll begin tonight's session. All right. So S-REITs kicked off 2023 with a very strong bullish start. January was in fact the best performing month since 2020, with the S-REITs index rising 6.6% month on month. So this even surpassed the STI, which only saw a corresponding 3.5% increase during the same period. So despite the rising rate environment, REITs have steadily been an active sector among our investors. So today, we will explore the topic of S-REITs, what is driving the resilience of the Singapore REIT sector compared with its global peers. Is it a good time to start investing in REITs today? And of course, what is the best way to start? So my name is Jason. I'm very excited to be able to host you this evening, together with what is certainly a very strong panel on my right side here. So without further ado, let me introduce our speakers. All right, so first you have Ritesh, who is the head of investment and advisory at Syfe. So he is a veteran of our online webinars and physical sessions, and he has certainly established himself to be a credible voice of reason for Syfe. Up next, we have Geoff Howie. Sorry, excuse me. So he's the founder and author of SGX My Gateway, and it is a portal that is packed full of insightful data. I've personally seen it. It's very informative. So it's available for viewing on the SGX website, right? And in my conversations with Geoff, I understand he's a F1 fan, and if you have a personal chat with him, you'll be surprised about his history with McLarens, all right? Next up, we have Chieh, a fund manager at Lion Global Investors. So he was also present at the launch of Syfe Cash Plus portfolio 2 years ago. So he has a wealth of experience in the Asian equities and the fixed income markets. And fun fact, he likes to run a lot in his spare time as well. All right, and rounding off the panel, we have Nirupal Joshi, CEO of REITAS. So REITAS is REIT Association of Singapore, for those of us who are unfamiliar. So she previously held multiple senior roles at Mapletree Logistics Trust, and I understand she likes to do a lot of volunteer work in her spare time as well. Right, so for those of you who are joining us here for the first time, this is Syfe's mission. We want to empower people to build their wealth for a better future, and these 4 individuals that you see on the screen here, they are actually a testimony to that statement itself. Right, you see here on the screen, Syfe Wealth and Syfe Trade app, or rather the platforms, and they are both accessible via a single app itself. So this gives us this allows our clients to be able to invest in a very holistic manner as well. All right, so with that brief introduction of Syfe, I'll now hand over the time to Geoff, who will actually bring us through the recent highlights of the S-REITs market. All right, Geoff, please.
Thanks, Jason. Thank you very much, ladies and gentlemen, for coming along tonight. It's great to see you, and really looking forward to the next hour and a half or so. What I want to do is spend a good 15 minutes to run through the Singapore REIT market with you, okay? We have approximately 20 cents in every dollar that goes to work in the Singapore stock market every day going into our REIT sector. So our REIT market makes up 20% of the day-to-day turnover, while at the same time also comprising 12% of the total market capitalisation. As Jason said, the index has started the year well, with the recent, I guess, nudge that global financial stability has had over the last 3 weeks or so. We've seen some of those early June gains come back a little. So our iEdge S-REIT index has generated a total return of around 3% so far this year, which is outpacing the FTSE EPRA NAREIT Global REITs Index, which is down, what's it doing? We're up 3%, and they're down around 6% in the year to date. So when you look at the actual performance of the FTSE EPRA NAREIT Global REITs Index and compare it with our iEdge S-REIT index, you did have very similar returns for the 3 years spanning 2020, 21, 20, and 2022. And then for the last 3 months or so, we've had a little bit of outperformance. So around 7% outperformance thereabouts for Singapore REITs. What I think is really important is that in the growth of our S-REIT sector over the last 20, 21 years, we've established, first of all, a local hub for REITs, then a regional hub for REITs, and then a global hub for REITs. And what's interesting is that the Singapore benchmark has returned very similar returns, if not slightly better, than the big global benchmark for REITs over the last 3.25 years, but at the same time, not being very correlated. If you look at the correlation, rolling correlation on a day-to-day basis between FTSE EPRA REIT and our IHS REIT, you've got around a 0.4 correlation coefficient, which means it's not that significant. And it means that if you do want to look for the returns that a global REIT hub can offer, you can look at Singapore. You can also look at the globe, similar returns, but not too much correlation, which is what portfolio managers really do look for in our REIT market. And as you'll see through this presentation, quite a few of our flows are very passive into our REIT market. We have 5 ETFs now that track REIT indices, 3 of which are tracking specifically Singapore REIT indices. And if you look at the combined AUM of those REITs, you've got around 850 million Singapore dollars invested across the 5, of which around half of the AUM is in the Singapore-related REITs. So in terms of the globalisation of our REIT sector, if you will, we've got as many as 17 REITs now that are exclusively investing in overseas properties. We have 20 REITs that are investing in both Singapore and overseas properties. And we have just the 3 REITs that are investing solely in Singapore. And then when you look across the very different countries that these REITs are investing in, you've got 14 of the REITs investing in my homeland of Australia. You have around 11 of the REITs investing in China. Another 11 of the REITs are investing in Japan. And you have 9 of the trusts actually investing in the United States. So you have quite a remarkable global mix of REITs in our market. In fact, 80% of the REITs are investing in across the world when you look across US, Europe, and Asia Pacific. So final, I guess, just for the intro, in terms of the parameters of the REIT sector, what's really important is the dividend yield of 7.6% on average for the 40 trusts that make up the S-REIT sector. So in the S-REIT sector, you understand you've got 2 business trusts in there, 5 staple trusts, which are basically a REIT plus a business trust stapled together, and the remainder are actually real estate investment trust as governed by the collective investment scheme. And the 40 of them have an average yield of around 7.6%. So that 7.6% is significantly higher still on average than the 10-year Singapore government bond rate, which today was around 2.9%. When you look over the long term, when you look at the history of the yield versus the government securities, when you look at an actual index, your actual index yield is lower than the average, and that's around 5% versus, as we say, around 3% for government securities. So the yield spread is usually about 200, 300 basis points, well, actually on average around 400 basis points, but over the last year it's been between 200 and 300 basis points, and currently around 300 basis points there or there. So that's one key metric of the REIT sector. Another is the actual gearing ratio. Okay, so the average gearing ratio of the REITs is 37.7%. There is a limit of 50% gearing ratio if your interest coverage ratio is at least 2.5 times. That's the ability to pay off interest. Generally, the 40 REITs average an interest coverage ratio between 4.5 and 5. And if you don't have that interest coverage ratio before 2.5, your leverage limit or gearing limit, ratio limit is 45%. So at the moment, it's around 37.7%, and this has been one of the drivers for the market outlook for REITs over the past 6 months or so, with the big increase in interest rates. So you've had the Fed Reserve lift their federal funds rate by 470 basis points between March last year and March this year. You've had the ECB lift its three policy rates by 350 basis points as well since July of last year. And all in all, you have these higher interest rates that have had an impact on the outlook for REITs. And what we've seen in terms of the performance of the REITs that have the lower gearing ratios, like SASA REIT, which has a gearing ratio of 28%, you've seen slightly less or slightly more defensive performances for the global REIT market, which has had to contend with these higher interest rates. With the REITs that have the higher gearing ratios between 40, 45, 50%, on the other hand, seeing lesser performances. But we haven't actually seen the value trade yet in terms of investors rushing into the market, looking at the price to book ratios, which the price to book is the key metric for the REIT market. You've had that premium to the book value be at like 20% premium over the last 3 years prior to COVID, and then that's come down to a 20% discount. So you've had a lot of variability in the valuations, and they've actually come to pretty low. But when you look at the performances of the 40 REITs this year compared to last year, look at the price to book ratios of the REITs at the end of last year, okay, and then which is on average around 0.8, 0.85, so a 15% discount to the book value. And then you look at the performance of the REITs over the last 3 months, it's actually the REITs with the higher price to book ratios, the higher premium to book ratios, that have actually generated the higher returns. And this is because of passive investing. A lot of those bigger REITs that are basically have the higher price to book premiums are also not just constituents of the major REIT indices, but constituents of the STI. So when you look at 9 of the best performing REITs so far this year, 7 of the 9 also are those that maintain the highest price to book ratios as well. So there has, in a way, been a market or investors looking into the REITs that are actually going for growth, more so looking for REITs to attract flows from institutions or retail investors that are at severe kind of low valuations or yielding high amounts. Gearing ratios have had a little bit of an impact, but much of the impact is where the growth has been seen. So you break up the sectors of the REITs. You have industrial REITs and diversified REITs that have been the strongest performers so far this year. Industrial REITs for the first 12 weeks of the year generated a median gain of 4% versus office REITs that generated a median gain or a median decline of 8%. Anyone want to have a guess why that was? I guess that's what you're here for. And we'll discuss this more in the panel. But inflation is one of these key big mega drivers, overarching drivers of the market. Just as decelerating growth, persistent inflation, higher interest rates, of course, financial stability and geopolitics make up the 5 big key risks and drivers for global markets. But inflation's all very different. It depends where the inflation is. If inflation is in services and tight labour markets and higher wages, as it is in much of the Western world, which is where we actually import our inflation from, then the outlook for the commercial office towers is obviously the outlook for the ability to generate revenue and increase the rental rates, get the positive rental reversion, might be a little bit tougher than, say, the industrial REITs, who are actually seeing their inflation drivers come off. The supply chain bottlenecks actually start to thaw, and supply chain measures are now as fluid as they were pre-COVID. Manufacturing, while we are contracting, we still have made significant gains in manufacturing growth overall over the last 3 years. And hence, when you look at the 9 industrial REITs that we have listed on SGX, every one of them reported positive rental reversions for the last quarter. So you have what's really interesting at the moment, a very receptive market to the big overarching drivers in the REIT market, quite a bit of variability on a day-to-day basis. You know, whatever the opposite of boring is, I don't know, but it's certainly not a boring market, because your outlook for interest rates has been just so fluid up to 2 weeks ago. Okay? Financial stability was the big global risk that hadn't been really on the radar of many investors. It did pop up on the radar last year in terms of the UK currency and those fiscal measures that were quickly pulled back. But the financial stability was again focused on in terms of the moves and the focus on the banks, the 4,000 banks in the US that were not able to increase their profits or increase their net interest margins as the Fed Reserve hiked by, as we said, you know, over 400 basis points, 300 basis points in Europe, had affected European banks that weren't actually structured in a way to be making money off the rising interest rates. So this is part of the process of the slowdown. Basically, interest rates go up. If you do have a weakness to higher interest rates, it will impact your economic activity. And this is the whole point of lifting interest rates. So because of that, because of the impact, the negative economic impact that the recent bout in financial stability and the weakness of some of these organisations that have and will be in the news tonight and tomorrow night with the is it testimony or is it whatever the TikTok bipartisan was it Spanish Inquisition? Well, that's what the FDIC and so forth have to go through for the next 2 nights, and you will read a lot more about their actions, but why it was so important, okay? So what this has basically meant is that the peak interest rates now in the US are not as high as we thought they would be this year from 3 weeks ago. So 3 weeks ago, we thought the interest rates would be in the US up around the 6% level for a peak rate. But now it has been repriced to around 5%, given the economic potential contractions that might come from the recent impact the interest rates are having, not just on the banking sector, but across various sectors in the US economy. So in terms of the outlook, it is still super fluid. I think there's a lot when you break it down in terms of the REITs. REITs that saw the highest DPU increases in the last quarter, you would know, you would guess what they were. They were the 5 hospitality trusts, okay? Hospitality trusts, which are those business trusts and the REITs that basically provide the hotels and have benefited from the reopening of Singapore since April last year. REITs have attracted something like $205, $210 million of net institutional outflows so far this year. But when you look across the REIT market and you break up that 100 billion combined market capitalisation, it's around half the REITs that have attracted outflows, while half the REITs by market value have actually attracted inflows so far this year. So it's a very mixed picture. Really depends on the ability for the REITs to grow growth. The metrics that investors are using to assess that really depend on like the actual metrics that generate the distributions, this distribution growth, as we said, for the industrial REITs. It can be positive rental reversions, revenue per available room for the hospitality REITs. The shopper traffic for the retail REITs is really important, but at the moment, it's very mixed, and I think really exciting sector. You can't just take REITs as face value now. There's actually 4 or 5 aspects of the REIT market, whether it's the China-related ones, whether it's the industrial ones, the retail ones, the data center ones. A lot in there to look beyond the benchmark. We have our IHS REIT index, but I encourage you all to really, think of some questions you might want to ask for the panel and so forth, where we can actually delve in and actually reveal just some of the dynamics behind the REITs and the various sectors, okay? So I should Done my 15 minutes, and I'll finish now. Thanks, Jason.
All right, thanks, Geoff, for the wonderful insights. I'm afraid I have to pause the session. There are a couple of people at the site, so I do have to ask everyone, if you do see an empty seat beside you right now, do move in to the left, all right? Can I just ask, especially on the left side over here, if you see an empty seat, just stand up and head over to the next side so that our other participants can join in as well. Right, and for those who are standing, we do apologize for the crowd itself. I do believe that it is a very popular topic tonight. Right, I do see a few empty seats there as well. Right, and while we are waiting as well, Geoff opened up the session. We do have a Slido poll as well. So if you do have questions, do get ready your mobile phones. Right, and yes, that is the Slido QR as well. So you can scan it, and if you have any questions, feel free to just post it up there. Right? Yep, we do have a couple more seats. Can I invite a few? All right, I thank everyone for your cooperation as well. All right, so without further ado, perhaps let me just invite the next speaker up on stage, Chieh, who will be actually sharing with us his perspectives on fixed income assets during this rising rate environment. Chieh, please.
All right, thanks, Jason. A very good evening, everyone. My name is Chieh. I'm a fixed income fund manager at Lion Global. So in case you're wondering why am I here talking about REITs, I'm not going to talk about REITs. Right? I'm actually going to talk about what I do, which is bonds. And bonds, by nature, we look at interest rates. And as Geoff has alluded earlier in his slides, REITs are very sensitive to interest rates. In fact, I got to thank Geoff because he's already covered a lot of my points. So I'll try to elaborate a bit further. So yes, so let's talk about interest rates. And to do that, let's look at the global economy. So on the slides here, we have the global PMIs. On the right, on your left-hand side, beg your pardon, is the manufacturing PMIs. You can see that manufacturing PMIs has been weak, and you have heard about, people talking about global recessions. So this is one of the key things that they're looking at. And one of the reasons why we are seeing a weakening global PMIs is because of the rate increase that we have seen since last year, right? Now, on the right-hand side, you'll see the services PMI. And if you look carefully towards the right-hand side, you see the indices turning up, right? Now, the services PMI has been strong, okay? And one of the reasons is post-COVID, people are going out spending. Now, let's look further into the US market, right? And as you know, US interest rate market is the biggest, and and Singapore interest rates correlates very closely to the US interest rates. So let's take a closer look at the US interest rates. Now, so inflation, right? Now, inflation, we all know, has been going up. We feel it in Singapore. In the US, inflation has been proven to be very sticky, and you might have read about it in the media. If you look at the chart on the right, top right, you see two very distinct lines, right? The red line would be the services inflation, and the blue line will be the goods inflation, right? And you see them moving two different directions. Services inflation has been going up, and this has been a shift in consumer spendings, right? And it's quite intuitive. During COVID, we can't go out, right? We'll be at home, buy things on Lazada, Taobao. And once COVID is over, economies reopen, people are going out there to spend. So in the US, you're doing that, right? The Americans are going out to restaurants, traveling, booking hotels. So all these are the services side of the economy, and they are still spending. And because they're spending, the services inflation has been very strong, and that has been one of the key drivers of US inflation. To make the services inflation even stronger, the US savings are still pretty high. Right now, if you look at the chart on the left-hand side, the dark blue line would be the savings rates. again, during COVID, right, the Americans were not going out to spend. So the savings rate went to a pretty high level, to the tune of close to 2 trillion. And not only that, they have been given government grants, much like what we have in Singapore. And this amount of saving is still high. They've been drawing that down. You can see that the blue line has been coming down from 2 trillion to roughly 1 trillion, right? And it can still go on. Okay, but at this rate, they're probably going to finish spending sometime end of this year, right? So in the meantime, again, services inflation has been strong. And last point on the right chart, the chart on the right bottom, employment. The employment situation in the US is still very strong. Labor is still very tight, right? So with a tight labor, people are employed, they are still confident of spending. So this results in a very sticky inflation in the US. And what does that mean? It means that the Fed has been busy, right? So the chart on the left-hand side shows the Fed fund rate. It went from almost zero during the COVID period, and they started hiking the beginning of last year. And if you recall, during the initial part of the Fed hikes, the chairman, Jerome Powell, was saying, oh, inflation is transitory. And that has been proven wrong. Inflation has been a lot stronger than what the Fed expected. So that created, volatility in the bond market. And as a result, the market had to reprice, and the Fed had to react to that by hiking more, very aggressively and very quickly in a short span of time. Right? So when rates go up very quickly in a short span of time, you have this stress to the market, and in this case, to the bond market. So last year was a very bad year for bond markets because interest rates rose. Over in Singapore, you see the chart on the right-hand side. I plotted the yield of the Singapore 5-year SGX, right? So the yields went up. Actually, it went from 1% to as high as 3.5%, and then recently it dipped. So that's a reaction we have on the bond market, and by extension, REITs, as I mentioned earlier, REITs are sensitive, and that's why REITs reacted the way they did last year. Geoff also mentioned about the volatility we are experiencing recently. If you look at the yield of the SGS, the right-hand side, just the last few weeks, you'll notice that the yield has dropped recently, right? That's the volatility we are seeing from all this that's been happening, right? You read about SVB, Signature, First Republic, and of course, Credit Suisse. That created so much uncertainty and volatility in the bond market. This kind of volatility is quite unusual, right? Typically, as a bond investor, you don't see the bond yields moving so much, right? In recent times, it has gotten a lot more volatile. And to be honest, it's hard to predict where's the next shoe going to drop, right? Because no one really knows. But on the point about SVB, just one slide on that, on the impact. Right now, I have a chart showing the lending conditions in the US banks. The blue line shows the lending standards, right? So the higher it goes, the tighter it is. Even before this crisis, lending standards were already very tight, right? Now, imagine now that you already had problem with the regional banks, the US regional banks, and the other banks would now be worried, right? So they will have to, or they're likely to control their lending by, and they want to conserve their capital. So if lending standards will be tightened, obviously the amount of loans given out will slow down, right? So that would be the red line. It's been inverted just to show the relationship. And when you see the two lines going up, in the past, the gray shaded areas are where recession happens. So potentially we could be in for that. So what's the impact of a weakening condition or rather a tightening condition in the US economy, and therefore potentially causing a recession? That has caused the market to reprice. Right now, this is what we call a dot plot. The dot plot will be, you see the scatter plot of the blue dots. That's what the Fed members project where they think the Fed fund rates would be right now. Currently, we're at 5%. They just hiked 25 basis last week. So we're now at 5%. So in this projection, they are saying where they think the Fed fund rates will be up to 2025 and beyond, right? And the red line would kind of show the average of the Fed's forecast of rates. Now, the green line is what the bond market expects, right? So two observations. First of all, the two lines are saying different things. The second observation is they end up roughly the same 2 years down the road. So back to the first point. The first point is that the market thinks that Fed would have to cut rate by end of this year. Now, Fed is saying something else. Fed is saying, no, I will keep rates at 5%. Who is right, who's wrong? Nobody knows, right? Until end of the year. And a lot of it depends on what's happening in the market right now. Again, back to your banking crisis. If it gets worse, Fed will have to cut. Now, the reason why Fed is saying that they are not going to cut is because they are still trying to fight inflation, right? And this SVB thing happened so quickly, right? So they can't really say that they want to give up the fight on inflation. But to us as bond investors, because it's so hard to predict these near-term things, we rather look forward, right? And to my second point, both the Fed and the market agrees that in year 2025, the Fed fund rate will be lowered to closer to 3%. So that's the key thing here, right? I mean, we talk about investment into, be it REITs or bonds. We think that the Fed hikes is largely done. Maybe another 25 more in middle of this year, but beyond that, they have to start to think about the risk to the US economy. Right? Already before the SVB blew up, they are already in pretty precarious state. When rates go up so quickly, something's going to give, right? So in the US, the first thing that hit the US economy would be things that are interest rate sensitive, right? Housing market, for example, that's the first thing to drop. So now you have this additional pressure from the banking sector, so things are definitely a lot more uncertain. So to kind of conclude this slide, we know that markets is volatile, but at the same time, we believe that the Fed is at the tail end of their hiking cycle. And with that as a background, I'll just quickly talk about how, as a bond fund manager, how we think about positioning the portfolios. So in terms of risks for bonds, so I kind of have two axes. So on the vertical axis is about default risk, right? The higher up it is, the more credit risk that you are taking. And then on the horizontal axis, that's the duration. So the longer dated you go, the more risky. So I mentioned that we are in a very volatile environment, and therefore our preferred place to stay is on the bottom left corner, right? So basically, stay defensive. So by being defensive, you're taking better quality and shorter duration. This slide essentially shows the difference, the impact of duration, right? The line in gray shows the index of a very long duration product, and the line in yellow shows a short duration. So obviously you can see that the short duration product is a lot less volatile. Now, how does that kind of bond funds compare against the other products? We know that yields has gone up, right? So therefore, when you buy a bond fund, you're buying at today's yield because Fed has already hiked rates to 5%. So you're getting today's yield. And therefore, you see that the funds that we manage, the yields are pretty high. And you compare this against, on the horizontal axis, that's the risk measure or standard deviation. So the bond funds by default, or rather by nature, they are shorter dated and they are lower in credit risk and therefore showing a lower risk. But at the same time, the yield is high, right? Back to the point about Fed hiking rates. So in short, We think that funds has a place, bond funds have a place in the portfolio. I won't go through these points, right? They basically produce stable income. They provide stability to your portfolio, and we think that it has a place in your portfolio. With that, I look forward to your questions. Thank you.
Thank you, Chieh. So up next, we have Ritesh from Syfe, who will share with us more about our Syfe REIT Plus portfolio. Ritesh.
Hi, everyone. Good evening. It is a pleasure to be here today and host this session on S-REITs, one of the most important asset classes for Singaporean investors. Today, I want to share a story with you. This is a story of how Syfe REIT Plus was born. This goes back to late 2019, when we were just a few months old company. And we were thinking, how do we create a mark? We were one of the last entrants into the digital investment platform or robo-advisory space. And I remember sitting down with the investment team, sitting down with Dhruv, Akiko, Richard, all of us kind of scratching our head to think through what is a product that we can launch in the Singapore market that is unique and innovative. And that is something that can help us differentiate our offerings with respect to all the others. After much research, we saw an opportunity in the S-REITs market. This is where essentially we looked at Singapore as a hub for REITs. We digged deeper and understood that Singapore really is basically one of the largest REITs markets in Asia. And SGX really was a pioneer in bringing together a lot of REITs into the Singapore market, homegrown as well as globally. This led us to think of the REITs market a bit more deeper. We knew Singaporeans were super interested in real estate. We love high-yielding products. So, the real estate market combined with the high attractive dividend yield of the REITs market was something to dig deeper on. Investors, however, we also saw that there were problems associated when investing into the S-REITs market. Investors were often burnt by investing into S-REITs that usually had very, very high yields, but at the same time, their capital kind of getting eroded because the prices went down. There were also a few funds and REIT ETFs in the market, but again, they were either expensive or the process of investing into them was not that straightforward. This is where we decided, how can we change the game and, again, make it possible for an average investor to invest into the highest quality REITs in Singapore. A REIT solution that is better than any ETF or a fund, and a solution that makes it super easy for investors to earn sustainable dividend yields. So the first step really was to identify and choose an index based on which our REIT solution was to be designed. We wanted to develop a passive index solution, but at the same time, be able to invest into the highest quality S-REITs. We chose the iEdge S-REIT Leaders Index because it tracks the largest and the most tradable REITs in Singapore. And at the time of our launch, there was really no other product that tracked this particular index. So, a little bit more about the iEdge S-REITs Leaders Index. As I shared earlier, this is an index created by SGX to track the largest and the most liquid REITs in Singapore. It has a strong capital appreciation bias and an attractive dividend yield of 5.4% on a trailing 12-month basis. In terms of the breakdown, it is fairly diversified across different REIT subsectors, right? So across office, retail, industrial, multi-speciality, data centers, and others as well. Even in terms of geography, the revenue drivers for these REITs are across the market. So while it has a home bias of Singapore, but as you can see, the iEdge S-REIT Leaders Index, the REITs are basically earning revenue from across the world. In terms of our own REIT Plus portfolio, then we went ahead and created what became Singapore's first direct index portfolio. In this, what we did was we took the iEdge S-REIT Leaders Index as the base, and then we added a lot of screening criteria with liquidity constraints, market cap constraints, diversification constraints, and then optimized it in a way such that you get access to the top 20 REITs in Singapore. It was also designed in a manner such that we could rebalance it on a semi-annual basis, and we could review the holdings periodically as well. As you can see, the REIT index that we are talking about contains some of the marquee names, right? These are names that you are very familiar with: CapitaLand, Mapletree, Frasers, Suntec, Keppel. So all the high quality REITs is what this particular index is composed of. In terms of the objective of the portfolio, we wanted to create a portfolio that can give a combination of income as well as growth. We created two versions of the portfolio. The first is a 100% REIT portfolio that basically consists of 100% exposure to S-REITs. So it is the portfolio that tracks the iEdge S-REIT Leaders Index. And the other portfolio, which is a risk-managed version of the REITs portfolio, I think, again, very relevant in the current environment as well as through the COVID periods where the markets are uncertain, you want a much more smoother ride. So if you want to remove or reduce the volatility of investing in a single asset class, this is where the risk-managed REIT portfolio can give you a smoother ride. In terms of returns, the 100% REIT portfolio obviously gives you a higher long-term total return, close to about 8%. And if you break it down, the dividend portion of the return is almost like between 5 to 6%. So out of the 8%, 5 to 6% coming in form of dividends, and the rest 2 to 3% coming in form of capital appreciation. Similarly, the risk-managed REIT portfolio, on the other hand, slightly lower return because of the more conservative elements of government bonds being embedded there, but essentially still generating a return which is between 6 to 7%, with dividend yield being close to 4 to 5% range. In terms of the performance of the REIT Plus portfolio, as you can see over a longer duration, the REIT Plus portfolio does give you a pretty healthy overall total returns, close to 8%, as I talked to you earlier. 2023 obviously has been pretty optimistic, and we've seen the REIT Plus portfolio get up to 5% on a year-to-date basis. Obviously, the last 3 years have been challenging for the REITs market overall, but we are seeing a lot more positivity as the Singapore markets and the global economy opens up as well. We have seen this even in terms of the dividend yield of the portfolio, which has risen from 4.5% during the peak COVID times to now closely going up to close to 6%. Even in terms of performance, and this was something that Geoff also covered, the iEdge S-REIT Leaders Index has performed pretty well on a year-to-date basis when you compare against global benchmarks and indices. And this is not just against comparing, the REIT index that Geoff was talking about, or the global REITs market, but also against the global equity market. So you see S&P 500 and the STI index, the iEdge S-REIT Leaders is still in a much more positive territory. And we really see REIT Plus as a resilient income generator. As you can see, REITs are structurally built in a way to give you dividends on a consistent basis. There is a requirement that REITs need to, for them to qualify as a REIT, you need to make sure that almost 90% plus of your dividends or income is given as dividends to shareholders. And that's the reason, even through the pandemic and through these testing times, you've seen a pretty healthy dividend yield from the REIT Plus portfolio. So it dipped a bit in 2020, 4.5%, but as you can see, it has still maintained a pretty healthy level, and now closing in again close to 6% dividend yield as we move forward. And I think this is the crux of our solution, and this is what we essentially tried to solve for. The REIT Plus portfolio was built to make sure that it is the most efficient solution when it comes to investing into the REITs market. You don't really need a CDP account or a brokerage account. There is an embedded feature where dividends can be automatically reinvested. Just this one feature essentially also covers the management fee that we charge for this portfolio, because just the dividends being able to be reinvested, that dividend, which is 6% or 5% odd, can add as much as 0.5% return to your portfolio returns over the long term. So that really means that the management fee that we are charging is kind of getting paid off by just the fact that we are able to reinvest the dividends on your behalf, versus when you invest in just a REIT ETF, the dividends keep on coming and accumulating as cash. So in a way, it is not very efficient because that cash remains kind of idle. Also, I think in terms of when you are investing into the REITs market, all the hassles, with respect to which REITs to buy, in what proportion to buy, having to cater to the minimum lot sizes and other things and all. You don't need to really worry about all of these things when it comes to the REIT Plus portfolio because we manage it for you. Plus, all brokerage and transaction costs are borne by Syfe as well. So there is no brokerage cost applicable when you're investing into the Syfe REIT Plus portfolio. We also track our benchmark very, very closely. So we have now live for more than 3 years. We have tracked the IHS REIT Leaders Index with less than 0.5% deviation, oftentimes outperforming the index as well. And I think one of the cool features that we've also introduced in our REIT Plus portfolio is the fact that you can actually use it as an income generator because you are allowed to take the dividends out on a quarterly basis. So there's a payout feature where the dividends can be credited directly to your bank account on a quarterly basis. Typically, most of the ETFs pay on a semi-annual basis in this regard. So this basically brings me to the end of the presentation on Syfe REIT Plus. I would like to thank all investors who have entrusted us by investing into the Syfe REIT Plus portfolio. Today, I'm also proud to say that if the Syfe REIT Plus portfolio was listed on the SGX index or SGX market, it will actually be one of the biggest REIT ETFs in this part of the world. So Geoff, I think, was talking about how the 5 REIT ETFs together comprise close to 800 million. So if you were to add the Syfe REIT Plus portfolio, I'm confident to say it will be way above the $1 billion mark in terms of the money invested into the REITs market. I'm very happy to take further questions as we move along through the session. But for now, happy to move on to the next segment of our program.
Thanks a lot, Ritesh. So right now, may I invite our esteemed panelists up to the stage to actually join us for a fireside chat. So Nepal, Geoff. All right, so for the audience, please, Slido slide is available. If you have questions, please feel free to post it up there as well. All right, over to you, Ritesh.
All right, good. All right, great. So let's move on to the next segment of our program today. Thank you, all the panelists, for coming in and being part of this session. I will start my discussion with Nupur. Hi, Nupur. Thanks for coming in.
Hi, thanks, Ritesh. Thanks everyone for coming.
Thanks. It's a pleasure having you here. Nupur, you've been the CEO of REITAS for now over 6 years. And as we know, REITAS is the REITs Association of Singapore and is the representative voice of the S-REIT sector. It was created back in 2012 as part of the drive to enhance the competitiveness and the attractiveness of the S-REIT industry. Over years, we have seen many strong REITs that have grown and expanded both in Singapore as well as overseas, such as Mapletree, CapitaLand, etc. With that perspective, I would love to know more about how the S-REIT market has overall evolved in Singapore, especially in this post-pandemic world, as well as your outlook on the broader REITs market as we move into 2023. What trends are you seeing? What government initiatives are you seeing as well?
Yeah, sure. Thanks for the question. So yeah, as Ritesh said, we are the REIT Association of Singapore, the industry body that represents Singapore-listed REITs. So what does that mean? So we are membership-led. Almost all the REITs that are listed in Singapore are part of our association. And not only the REITs, but also all the key players in the REIT ecosystem. So the bankers, lawyers, trustees, consultants, and so forth. So essentially, we are kind of like the melting point of a pot of all the whole REIT ecosystem. In terms of how the REIT market has developed, so last year we actually celebrated 20 years of Singapore REITs, and it was quite a momentous. So this year we are 21, so now we are officially an adult. So a lot of changes in the last 20 years. When the REIT market first started, for those of you who may know or are old enough or were following, the first REIT was Capita Mall Trust, pure Singapore play retail REIT, and that was the kind of trend that happened over the first few years of when the REIT started. It was the local sponsors, big local names, often Temasek led, with properties in Singapore. So that was the first wave of REITs. Then as the REIT market grew further, and with the support of SGX and MAS and so forth, we became a bit more regional. So we started investing in properties outside of Singapore. China and Australia were some of the early ones. So this part of the world, and we also started getting the REIT sponsors who were not Singapore developers, but people from, fund managers from overseas listing over here. So that was a second wave. Then we had the third wave where we thought, why limit ourselves to Asia? It's a big world out there. And so that's how we moved into attracting sponsors from Europe and the US to list in Singapore, and also our own REITs that were listed here, our homegrown REITs, they started expanding into these Western geographies. So it's been a very interesting almost 21 years now. As Geoff mentioned in his presentation, we are now a global REIT hub and largest REIT market in Asia, ex-Japan. And one of the key things that differentiates our market is that you can actually get exposure to real estate in many parts of the world just by investing in a Singapore-listed REIT. So that's the journey in a nutshell of the REIT market. In terms of outlook, I think between Toshi and Geoff, the main points have been covered. 2020, COVID, maybe I start from pre-COVID, we were on a fantastic growth trajectory. I think 2019 was really the last wonderful bull year for many sectors of the market, including REITs. In fact, just to quote a statistic, 44% of the REIT IPOs globally in 2019 were in Singapore. So that's how international and important REITs had become. Then, of course, COVID happened 2020 and 2021. It was very challenging. And I can tell as an association, we were working very hard behind the scenes, talking to regulators, and talking to our REIT managers, because obviously when consumption is not happening and people are locked in due to lockdowns, it pretty much eats into any business, but particularly a REIT business, because REITs are meant to be regular dividend distribution products, right? But how do you distribute dividends if the rentals are low? Or if, as for those of you who know, in Singapore, for a while in 2020, the government actually said for 2 months, provide rent-free, because even the tenants were going through so much stress. So it was a very difficult time. And as an association, we played an important role in kind of bridging or communicating the anxiety of our REIT managers, who are so committed that they, to provide distributions and dividends to investors. But on the other hand, there was this big pandemic that was happening. So when we have time, I'm happy to narrate lots of stories from that era. But most importantly, we got through that. Most REITs are now, their DPUs, their distribution per units, have pretty much reached the pre-pandemic level. So that's another sign of the robustness of the REIT market. We thought 2022 was going to be great with things opening up, but lo and behold, the Fed started tightening. So it was a very bad year for REITs, unfortunately. Demand was gradually picking up on the ground, but then the interest rate shock was really quite brutal. And so now we are here in 2023. We are towards the end of the rate tightening, as we saw from the dot plot that Toshi showed us. We are towards the end of the rate tightening. The outlook is for interest rates to go down. You can have your own view of what that trajectory will be, of how much more they will raise rates before they start declining. But we are definitely closer to the peak of interest rates. And it's actually now, I think things are looking up, because when that outlook is there that interest rates are no longer going to go higher, then it's historically been very good for REITs in general. So we can probably discuss more, but I know I've taken a lot of time.
No, thank you so much. I think that was a great perspective, and I think it's a good segue to kind of move to Geoff. So Geoff, thanks for the excellent coverage on the S-REITs market earlier. You're obviously one of the key experts when it comes to the Singapore securities market, and privy to the SGX flows in terms of both institutional as well as retail. Obviously, 2023, while we have begun on a positive note, it's still very volatile, and there is still a lot of uncertainty from a global macro standpoint. Would you be able to share a little bit about how investors are looking at the S-REITs market this year, as well as shed some light on, the S-REIT sector flows as well as performance? I think you touched upon it a little bit towards the end, but I think a little bit more insights into the sector-specific flows and all will be very interesting.
Sure. So, yeah, pretty tough year last year for REIT markets with those rising interest rates. So last year we booked around 1 billion Sing dollars of net institutional outflows in the REIT market. That was predominantly your Frasers and your Maple Trees were among the REITs that booked the most outflows, and they, of course, as I said, that they maintain. Well, hello, goodbye. Hello. Yeah, sorry. It was Cedric's the guy that works very hard in the booth there, and I do a lot of these talks, and I think he's fed up with me already. With so many talks so far this year, he's just like, nah, he's had enough. Sorry, the thing about the flows is, a lot of the big index constituents did attract the outflows last year. Some REITs did attract inflows last year. Suntec REIT booked inflows for the first 9 months of last year. Your hospitality REITs booked inflows. CapitaLand Integrated Commercial Trust generated a very defensive performance last year and booked inflows. So REITs that were benefiting from the reopening momentum did attract inflows. But what we had was also retail inflows last year, I think were around 1.5 billion. So you actually had the market makers having to sell REIT units as well. This year, you've also had, as I said, institutional net outflow of 200 million and about retail inflow of around 160, 170 million. But you've had sector switching, which was what we've seen in the broader stock market. Like tech stocks were the most sold off sector across the world last year, and have so far this year been among the strongest sectors so far this year. So this sector switching has actually been seen across the sub-segments of the REIT market, so that the REITs that have attracted the inflows this year are your Maple Trees and your Frasers. And then Suntec REIT, CapitaLand Integrated Commercial Trust, which I said was some of this, saw some, Suntec saw the inflows for 9 months, and CICT did attract inflows last year. They've attracted the outflows. So measured moves in a way. But I think making sense of it all, one thing as well with REITAS is they have an excellent website for education, and it's not just supporting the managers, but REITAS and NUPA have been really busy on the education circuit. I think the Share Investor REITAS Symposium's the 3rd weekend of May this year.
20th May.
Okay.
Look out for that.
Okay. But what I'm saying is getting educated on the actual, the glossary, the glossary on your website's second to none, with getting help with understanding the jargon and so forth. But as we said, this year you've got a number of downside risks. You've also got potential upside risks. Going for growth is really important. And it's also important, I think, to look at the REIT sector as professional asset managers as well, because the bulk of them, 5 + 7, 33 of them that are actively traded for listing are collective investment schemes. So these are asset managers that don't want to look to provide as much income as they can on a semi-annual or quarterly basis to the unit holders, but they also want to increase unit holder value. And over the last 3 years, proactive capital management has seen strategically half the REITs, at least half the REITs, more than half the REITs make acquisitions over the last 2020 and 2021 to the tune of around 20 billion Singapore dollars in total over those 2 years. And then at the moment, as the the economic outlook is more uncertain, you're starting to see more disposals. So asset acquisitions, asset disposals are also at their means. So there's a range of tools available for REITs to be able to basically provide unit holder value, through the asset acquisitions, the disposals, the asset enhancement initiatives, some of the industrial REITs looking to make their properties more green certified. It's such an interesting, compelling segment and sector. And you also work a lot with those investor relations folks at the REITs as well, who do publish on our company announcement page, which is quite a lot of detail and presentations for you to nail down and look at individual REITs and so forth.
Absolutely. I think the investor education piece is a key component. This is one of the key aspects that we also kind of build into our process. We constantly keep doing these kind of sessions as well as internal learning events to make sure that our investors understand what they're investing into, and they're patient. I think the biggest problem that I see when investors are in the markets is they lose patience, and typically the markets rewards you for being invested over the long term. And while again everyone says that that I'm long term, but once you see 1 year, 2 years of negative returns, it becomes incredibly difficult for investors to stay the course. But this is the education part that we have been, harping upon, over and over again to our investors. Luckily, I think throughout last year as well as through this year, we've had always net inflows into our REIT Plus portfolio. So that's really incredible. I think people are able to reinvest dividends and, really grow the money. So that is something that is very encouraging. But again, I think hopefully sessions like this help the overall investor base to learn more about it. Switching over to Chieh. Chieh, thanks for covering the SGD rates outlook earlier as well. I think it's also a very interesting time for the bonds market. You've obviously been a veteran and invested as a portfolio manager for more than 2 decades now. I think the last few years have been a bit challenging for the bond markets. We've seen volatility coming in different forms, first through the Chinese markets, the Evergrande issue, those kind of things. But more recently and more now, as we see with the SVB collapse, we see the Credit Suisse takeover, and some of the components of the bond market, such as the AT1, COCO and all, being completely wiped off. So this obviously has brought investor concerns. Obviously market regulators have come out, clarified some of these points. But how do you think investors like us can understand some of these risks in a more meaningful way, as well as are there bigger contagion effects that we should be worried about as well?
Right. Thanks, Ritesh. Maybe just a quick background. You guys heard about the Credit Suisse situation where the AT1s were wiped out. Now, AT1s are part of the capital structure where they rank above the equity. So in theory, there is a hierarchy where equity normally gets wiped out first, right? They should take the hit first. But for some reason, the Swiss regulator decided to wipe out the AT1. The AT1 is the one that sits above the equity. Now, ever since that episode, the ECB, basically all the central banks, right? ECB, the BOE, Hong Kong, HKMA, Singapore MAS, they've all come out to say, okay, we will respect the hierarchy, right? In other words, equity holders will wipe out first before the AT1s will get wiped out, and so on. So that was the clarification by the other regulators, and kind of snubbing the Swiss financial regulator. But in terms of the impact on the bond market, on the broader markets, so obviously AT1s sold off, right? The other AT1s sold off. And because, now, typically banks would have to refinance the AT1s by issuing new AT1s to replace the old AT1s. With the market as it is now, it's very unlikely that banks will be able to refinance the AT1s, because there are obviously no appetite for AT1s. Now in Asia, even though the regime is more investor friendly, the prices have also dropped. So the impact to the banks, obviously, the cost of capital would have gone up. So banks, because they can't raise AT1s now, they have to maybe raise equity if they need to, or raise other part of the capital structure. Now for investors, so I think a lot of investors, well, the ones that bought into the Credit Suisse AT1, I suspect some of them didn't know what really happened. And to be honest, I think AT1s are not, it's a bit hard to understand. It's probably not for retail investors to get involved in, and it's also pretty risky, right? So it's actually more like equity than bond. And I kind of, relate to your point about investor education, right? So unless you think that you really know what this product is all about, then I would suggest not to be involved in. For our firm, we do not buy a lot of AT1s, right? Even though we have, full-time professionals looking at this market, we decide not to take, or rather we have a very, very small amount of AT1 exposures. For retail investors, I think, like Ritesh says, do your homework, get involved in educating yourself through these channels, and buy something that you are comfortable with. So that's the doctor's advice.
Thank you. Thanks, Chieh, for sharing your thoughts. Coming back to Nupur, REITs are obviously one of the largest real estate owners holding an extensive portfolio of physical buildings, which are also, in a way, a primary source of carbon dioxide emissions. I think it'll be interesting because, with the whole, I think, focus on ESG, and especially the E part of the ESG, how are REITs specifically tackling this component?
Yeah, sure. Thanks, Ritesh. So ESG has been a very big topic for REIT managers. So just in case, ESG, environment, social, and governance factors. I think the governance factors have always been there. We are a highly regulated industry, so there's nothing new in that. The social part, every corporate has some kind of CSR or corporate social responsibility program. So a piece of it has been there, but we are working, there is now an added focus. But the E part, which is the environment part, is very new. And why is it new? Because, 3 years ago or pre-COVID, I don't think we knew we were talking about, net zero, climate crisis. These are terminologies that have, for us finance people or even normal people, I think only the climatologists were talking about it, but over the last 2-3 years, it's entered the business world. And why is that so? Because now more and more, there are regulations governing corporates, including REIT managers, about different aspects of managing the environment. So one piece of it is risk management. So for a REIT manager, how is a REIT manager who is an owner or managing a portfolio of properties, what are they doing to ensure that their properties are kind of first of all, has a REIT manager done an assessment of how exposed they are to various climate risks, physical risks, earthquakes, floods, typhoons? Because as we heard, our properties are all over the world with different weather patterns, changing weather patterns all over the world. So there's an analysis that needs to be done about how exposed the buildings are. So that's one piece of it. Then and that is called physical risk in a very kind of, in the climatologists or dictionary. Then there is another piece of risk management, which is transition risk. What does that mean? That means that as the whole world globally, we are moving towards net zero. The target is by 2050 net zero. We don't know whether you'll achieve it, but we are all trying. But while we are moving, changes are happening. Changes are happening to regulations, becoming stricter on environment. For example, the carbon tax is going up, already announced, different different amounts in different countries, but it's a fact, it's happening. Customer preferences are changing. And in our case, as a REIT, as a landlord, tenant preferences are changing. More and more tenants want their buildings to be kind of green certified. So that's a trend that's happening. Investor preferences are changing. More and more investors want to invest in a product that is more taking into account all these climate-related factors. So there's a whole risk management piece of environment risk management. And MAS has actually come out with guidelines for all financial institutions, in which REIT managers are part of financial institutions in Singapore, on environment risk management. So now we are all required. All the 40 listed REITs have done environment risk management of their portfolio and documented it. So for those of you who have the time or inclination, just go to the sustainability report on each REIT's website, and it's all there. And part of that environment risk management is climate reporting. Task Force for Climate-Related Financial Disclosures, which is a requirement not only from MAS side, but also from SGX side. SGX requires all listed companies to do climate reporting. So obviously, REIT managers are not climatologists. We are not environmentalists. We are essentially either finance people or real estate people. So it's a lot of learning that has happened and is still happening over the last just 3 years or so on how to really understand, assess, and document. And then after we've figured out, okay, this is what our risk profile of our portfolio is, what are we going to do about it? The mitigating things. What is our target? Do we have a net zero target? How are we going to get there? The roadmap, the strategy. Is everyone along the value chain of the REIT aligned, from the guy who is at the property, maintaining the property, to the portfolio manager, to the CFO, to the CEO. So there's a big change happening. So that's one piece of it. The other thing is, it's not just about risk management. It's also about opportunities. Whenever there's a change, there's an opportunity for those who understand the trends and are able to capitalize on it. So in the current context, for example, there are many green indexed products that have come out. There's a green REIT ETF as well. Those REITs that are doing better on the sustainability front, who are benchmarked higher by the various benchmarking agencies, they make their way into the ETF, they get more fund flows. And that trend is only going to increase. So it's an opportunity. It's an opportunity for REITs managers to really differentiate themselves and to show their quality, to show their management focus. They believe that their understanding of where the world is heading, of what the tenant and the investor of today and tomorrow wants. It's quite a change from just managing a property and being a conventional landlord to really taking into account all these factors and thinking strategically of how to position yourselves to best capitalize on this. Then there are many other aspects of the E. I mean, I have a long list. Green building certifications. Most REITs now either publicly have mentioned some target about how many of their buildings are currently green certified, how many they expect to get green certified or target to get green certified. So everyone is pushing to make sure that their properties, their buildings are in kind of aligned to produce using the resources more efficiently, using less of energy, managing the water, managing the waste. For buildings, they are just the three main components that are part of the management of the E, or the environment, is really energy, water, and waste. So there's a big push on the part of REIT managers to really optimize or minimize energy use and waste and water. So then there is the green finance part. There's a lot of, we've heard announcements from all our local banks have already got their own net zero commitments, and they've made statements that we are going to do more and more of lending to companies that have a certain roadmap as it relates to environmental or overall ESG commitments. So again, if a REIT manager wants to be able to access the funding, they need to make sure that their REIT has a strategy to move towards the target of becoming greener in some sense, right? And then if they do, and if it's a credible target with a credible roadmap, they will have more access to funding. So there's a whole green finance piece. And I must say that in Singapore, almost half of the green finance which has been issued is actually to the property sector, out of which a big chunk is REIT managers. So we are really in the forefront of this. Then there's green leases. I mean, the terminology goes on and on. Green leases essentially having some data sharing between the landlord and the tenant. It's not like before that, you sign a lease contract, pay this rent for X amount of years, and then bye-bye, I see you after 3 years when I come back to renew the. Now it's all about, over the term of when you are in this property, how are you using the property? How much of energy are you consuming? What features are you, or maybe I should say it another way, how much of energy, water, waste, how are you managing it, and how can there be greater cooperation between the landlord and the tenant to manage it in the most efficient way, and also for the landlord to be able to get data from some of these properties so that they can report it, which is required, as I just mentioned, in a full circle, that we are required to report a lot of the environmental statistics in our sustainability reporting. So I guess should probably sum up this little piece by saying how do investors benefit? Investors benefit because now you know that REIT managers are paying attention to something that is going to be already is getting vitally important, but is going to get more and more important, and they're already paying attention to it. They've all drawn out roadmaps. As I said, the sustainability reports are there to document what they have done, what they are doing, what they plan to do, and to make a year on year. So you know something is being done, you just need to open the report. It's a bit difficult to read, but easier way to do it, maybe look at the benchmarking or the ratings. Almost all REITs will have some ratings given by GRESB. I think SGX website actually lists down the ratings given by the different sustainability rating organizations, so you can just take a look and you will have an idea. I think a rating on sustainability kind of is just another data point to show you the quality of the management and the long-term strategic thinking of the management. Okay, I should stop talking.
No, thank you so much.
There's a lot in there, and I should add in to say that because it's such a steep learning curve for everyone in every industry, as an association perspective, we are actually running a lot of courses and seminars for the people working in REIT managers, not only for junior staff and mid-level staff, but all the way up to directors and boards of directors, to really help everyone understand and appreciate the importance of integrating all these environmental considerations into what is a REIT management business.
Because it is really important for investors. If a country decides to be net zero by, say, 2050, it means all the corporations have to reduce their carbon footprint. So as Nupur was saying, there's a lot of reporting of the carbon footprint, and we're seeing, because of that reporting, capital markets are playing a really key, crucial role in this. It's capital markets that have the ability to have an index and then take that index, and yes, yield is super important for the REIT sector. So your index will select its basket of stocks from obviously high yielding REITs if that's an objective, but at the same time, it can take the reported metrics and tilt or increase the weightings to companies that are reducing their carbon footprint, that are reducing their greenhouse gas emissions, that are reducing their water consumption, and give those companies more weight in the index, so they get more money from the investors, where the companies that aren't reducing their carbon footprint per se get lesser weight, and therefore they get the less money from the investors. And that's a key thing that will be shaping more and more of the indices across all the different index providers. And as Nupur said, we have an ETF that's based on that, the iEdge UOBAM Green APAC ETF.
Awesome. Just in the interest of time, I'm just gonna, wrap up the two questions together. So we'll go Geoff and Chieh. I think the first question is more about REITs as an asset class, how it behaves in inflationary environments, and compared to, say, equity markets and all, is REITs a better asset class when it comes to performance during these events, as well as how does REITs fit into the overall portfolio construct of clients. In terms of, bonds, REITs, equities, if you're thinking about your overall portfolio construction, then how does it all come together given the current environment? And as we are moving forward, we are at potentially peak interest rates, but that potentially should also open up more opportunities in terms of diversification and going beyond a traditional, say, 60-40 portfolio. So maybe we'll just quickly go one by one.
Yeah, it's the key driver of inflation. It really, at the moment, you've got a tightrope between persistent inflation and decelerating growth. So REITs can obviously look to change their rental rates every year, let's say, and therefore increase their rental rates in high inflation. However, the decelerating growth at the same time might mean you have no tenants to increase the rate for. So you have to be specific when you look at the various different rates and the actual drivers of inflation. At the moment, inflation is global and it services inflation. The key metric the Fed uses is the PCE deflator ex housing services. It's a sub-aggregate. It's been between 4 and 5% for 18 of the last 20 months, so it is persistent. Now, this can obviously, if they keep the rates high at this time, can make it hard for you to find an inflation hedge if it has a detrimental effect to the businesses of the tenants. So you have to look specifically what are the less elastic properties to the economic cycles that we're seeing. In the stock market, you've just got to kind of, there's no hard fast rule. You have to look at stocks like Sheng Xiong Group, which say that, okay, if the rising inflation is going to actually impact the cost of living, then you'll have consumers looking more to buy home groceries from Sheng Xiong and spending less on the restaurants, and that can actually help their business. For us, anything Sing dollar related is obviously a positive if you're looking at an inflation hedge, because we're 0.4% of the world's economy, but we're 3% of global trade. We import a lot, we export a lot, and therefore, because we can import so much inflation, the MAS has to use the Singapore dollar as its policy lever. It's had three slight appreciations of the band, 3 recenters, which has basically meant that gold is the ultimate hedge. Wasn't needed for Singaporeans last year. Gold actually returned negative return of 2% for Singaporeans last year, our gold ETF. But if you were a Japanese investor and you invested in the Singapore gold ETF, you actually made 13% because the currency provided the buffer for the inflation based on MAS policy. So beyond the currency, you can break down and look at the actual segments of the market that are less impacted potentially from the decelerating, not just the high inflation, but the decelerating growth. One final point, we have around 250, 300 REITs across APAC. The industrial REITs in 2020 and 2021 average total returns near 30% because manufacturing global trade was resilient and able to stay open because it wasn't consumer dependent during the COVID containments. The rest of the APAC REITs across APAC, obviously, generated negative total returns on average. So picking the right segment for the right inflation drivers and growth drivers is pretty critical. And as we said, SGX and REITAS can help with that education.
So just a quick one, Chieh, I think we'll have to move over to the next section.
So the quick background, as I showed in my slide, is that Fed has really done a lot of work in bringing up rates. Has it reached a peak? We don't know, but closer to the end than the beginning, right? And therefore, we think that rates eventually will come down, right? Now, that it could still be volatile. So therefore, the way we think is that, you have to stay invested, but be defensive. And in that context, a bond portfolio, it fits that purpose. REITs also has a place, right? REITs has a stable source of income similar to bonds. So, therefore, these two are pretty critical elements in the portfolio.
Awesome. Thank you so much. I'm not sure if we have enough time for audience Q&A. I know there are some questions there. Jason? All right. Okay, there we go. So we have a few questions. I'm not sure if we'll be able to take all of them, in this particular, session, but we will be available after this as well. So please feel free to reach out to us individually if you're not able to take all of them. Let's maybe take the top 2. I think there is one which talks about interest rate impact on the dividend yield for REITs. I think we talked about it a little bit, so we can go a little bit deeper. I think a related question is on the future fund interest rates for 2023-24 and what's the max rates and timeline. And I think the more important question, I think the stagflationary environment. I think one of the aspects that you also highlighted was the fact that if it is, growth, but it is like, muted growth, but there is inflation, that can be a bit of a dampener. But if it is growth combined with inflation, that can be a bit positive for the S-REITs market. So just, I think maybe we go one by one. Just want to hear your thoughts on all of these points.
All at once.
All in one. Yeah, let's go.
Okay. The Fed sees inflation not coming down to below 2% now until 2025. So that means future fund interest rates are potentially going to be high unless they change the parameters. Remember, once upon a time, the Fed funds rate was either quarter or a half or a 1, and then they changed it to a band. So there might be ways that the policymakers across the world adapt to the fact that we might have sticky inflation for some time, find a way to address the cost of living, and then obviously have a higher interest rate parameter. So I think you've got to have a very open mind. Yeah, so at the moment, the CME Fed Watch tool is exactly like you said. It was for a little while suggesting no rate reprieve this year, but we are expecting reprieve, but it's not expected to come down for a long time. And this does impact the dividend yield for REITs, because REITs do not just issue units to the unit holders, but they also have debt. And if you have debt, you have to pay and repay their debt. Now, I think 75% of the debt is fixed and hedged and so forth, but there's still 25% that isn't. So if interest rates are higher when it comes to repaying the debt, it means you have less money to give back in the dividend yield. So it does actually have a contraction impact on that, but not the same for every single REIT. The stagflationary environment does affect S-REITs, but like I said, there's just not one type of S-REIT anymore. There's healthcare, there's data centers, there's industrial, there's retail, there's office, there's industrial. And if you have a stagflationary environment and you have more demand for streaming because there's less people working in the whole world, then you might have more demand for data centers, and that might actually see them outperform. And if global trade picks up and tends to be more cyclical and quicker to pick up and quicker to fall than GDP, then you obviously had the need for depots and logistics centres across the region, and that impacts industrial REITs different to, as we said, hospitality REITs that might feel the pin from cost of living increase. And many commercial units can be empty if the occupancy rate is now yeah, markets are sped up. They're very forward-looking, determinedly forward-looking. Hospitality REITs outpaced last year, very strong, because of the expectations of their DPU increases, which did come in the last quarter, up 30% year on year. So markets do move very quickly, very forward-looking, but I'm not sure about whether they're empty or so. I think the occupancy rate is the actual metric you need to look at for the actual REIT.
Awesome. Just quick couple of lines, maybe. Nupur.
Yeah, maybe I'll take the second one. I just add a few more points. So interest rates impact on the dividend yield. I think that's what was negatively impacted last year. Yes, around 75% of the debt for most, on average, for REITs is hedged. What is also important metric is the debt maturity profile. That is, when is that debt maturing? When is it that they need to refinance it? And so if the debt is only maturing 2-3 years down the line, then you're in a safer situation, because by that time, hopefully, interest rates would have come down. So by the time they're ready for refinancing, they'll get lower rates. So the actual fixed ratio of debt is important. The debt maturity profile is very important. The other way interest rates impact dividend yield is the yield spread between typically, your risk-free rate, which is we usually take as a 10-year government rate, and the REIT dividend yield. So as as you mentioned, the average historically is around 400 basis points. Right now it's 300, so it's a little less. But as that gap shrinks from 400 to lower than 400, then obviously it means REITs are relatively less attractive. But now, as interest rates hopefully will start coming off at some point, that gap will increase again, and that will make the REITs relatively more attractive. So it's all a relative game. Maybe on the next point, on the stagflationary environment, frankly, we are as much exposed to global macro as anyone else. It's an equity product. If the whole world is in recession, we are all going to be impacted. But if there is pockets of growth and pockets of deceleration, then it's a pick and choose, right? So if a certain region is facing a downturn, then there are REITs in other geographies, which is why when we say that Singapore is very geographically diversified in terms of where our properties are, that's where the pick and choose happens, right? You see, maybe the Western world not doing well, but China doing amazingly, go buy the REITs with China property. So that's where a little bit of understanding of where the properties are located comes in. I know it's difficult, you may not have the time to do that research, which is why then we just fall back on the simpler investing option, go with the ETFs, go with the Syfe kind of a passive investment. You can't win everything, but you're roughly there. You're roughly at least getting the broad sector trend. But just to caution that, if the whole world goes into a recession, then everyone will be affected, including REITs. But staple consumption, staple consumer behavior, suburban retail, maybe they are okay. As Geoff said, maybe data centers may be relatively okay, but we'll all get affected. The last one on commercial properties, I think you may know that offices have been having a hard time. All of us kind of enjoying our hybrid work arrangements. Some bosses want us back, some are more flexible, but it's certainly a time for the office REIT managers to think very hard of what is the best way of using their space. It's not, you would think that being a landlord is easy, but it's actually very, very difficult, because the way space is being used is changing. And I think that's most apparent in the office sector. And again, those REIT managers that have the foresight, that have the kind of, willing to take a view on how the market will evolve and then position their property or make changes to their property so that it meets the demand of the consumer. Those are the REITs that will do well. So, just my
apologies. Sochi, maybe, we'll stop here in interest of time. I know we are running really, really behind. So it's 8 p.m. and people need to go. Before that, I would like to call Dhruv onto the stage to give a quick note from him.
Hello, everyone. So it's great to see actually a full house. I think this is our first proper full-strength event that we are doing since COVID, and that's very exciting. We did a smaller one, but it's so good to see a full house here, so much so that we had to open the neighboring room. Now, last year was a challenging year for the global markets. I don't want to, again, said that has been said already, but it's been quite fascinating to see how REITs have not only outperformed, but done extremely well with this good start to the year and the 7% yield that you saw in Jan, and still actually outperforming the relative benchmarks and indices. Now, this is our third year of a partnership with SGX of launching the Syfe REIT Plus. And it's really exciting because this is something we don't talk a lot about, but the ability to invest, whether you're investing $1 or you're investing $1 million, and we have both of those audiences in the room today, and giving them the same amount of access is a very personal mission to myself and the team at Syfe. So the fact that everyone, no matter how much you have to invest, can access that quality and have some really cool features like automatically reinvesting your dividends, it's very powerful. I mean, just think about it. If you're going to get 6-7% dividend yield, and if you're expecting a similar return on an annual basis, it's another 40-50 basis points that get added to your portfolio on a regular basis. The SGX is a very unique place, as you know, this ability to attract some of the highest quality REITs, REIT manufacturers. And you're seeing even that with the diversity and the optionality that comes in the market. One of the largest markets in APAC. It's been very exciting, when we conceived on this product, back in 2020. And it's fascinating to see how far and it has come. I would probably go and say we are probably the biggest Syfe REIT Plus is probably the biggest S-REIT product out there in the market. I wouldn't give on more insights on the S-REITs. I think we've had an incredible panel discussion, some incredible insights and learnings across the market. I think, as Geoff said, in a world where inflation rises, a product that is giving you passive income, of course, concerns of interest rate, concerns of unutilized commercial property have all been highlighted. But it also makes a very strong case of something that needs to be a part of your portfolio. And that is something, as you have seen, the strength in numbers and the performance as you've seen in the start of this year. So with that, I'm very grateful to have our special guests from SGX, Lion, and REITAS to share their perspective. It's with your continued support that we look forward to delivering on our commitment to innovate and to continue delivering institutional class products, but making them available for everyone. Last but not the least, I would like to extend my personal thank you for all of you who've managed to come here. It's 8 p.m. On a Tuesday evening, and you could be doing many other things. So thank you for joining us today. And for those of us who are joining us online, look forward to some very exciting updates coming for us in the coming months. And thank you again for your time today. Thank you.
All right, thanks everyone. I know we are way past our initial timeline, so I won't hold us back too long. Just want to follow up on the questions. There were many good questions that were asked today, and I'm pretty sure not all of them were answered. So we do have a weekly newsletter that we do publish every weekend. So if you are not signed up for that, do sign up for the weekly newsletter. We'll actually follow up the questions over there as well. Cool? All right, so with that, thank you everyone for a wonderful evening. Refreshments are outside. Let's thank the guest speakers as well.